All right, we're back with annualized returns averaging 10% over the past 25 years. Jay Bowen's fund is in the top 1% of its peer group, and his investing strategy has even earned him comparisons to Warren Buffett. In fact, Mr. Bowen has been called the Oracle of Tampa for the way he's managed the Tampa Police and Firefighters Pension Fund. He's back with us today live from Atlanta. Jay, good to see you again.
Thanks. Good to be back.
So we just got done with a pretty good conversation here about where the guys on the desk in front of me think the market's going, where Carl Icahn has his concerns about the market. How do you feel as you sit here today?
Yeah, I think a pretty strong case can be made for stocks to continue to be range-bound with a slight upward bias. On the one hand, you do have modest earnings growth. You've got a positively sloped yield curve, which is getting steeper. You have stable inflation, those are all certainly positives. You have subdued credit spreads. The problem is, over the last 3 years, stocks have had annualized returns of around 15%, whereas earnings have grown during that same period about 5%. So there is a gap. And if you believe that there's not a whole lot of room for multiple expansion, and if you also believe that profit margins have crested, then, which we do, I think that we're going to revert back to an era where stocks reflect, basically returns reflect earnings growth plus dividends, which puts you really firmly in the mid-single-digit camp. Now, I will say this, there are a couple of wild cards. One being the foreign exchange value of the dollar.
Right.
I think the most important price signal on the planet right now is the euro-dollar cross rate. And if you look at the action last week after Yellen's press conference, I think it's more than a coincidence that the market had its best week in a couple of months when the dollar settled down and Yellen gave some somewhat dovish conflicts. There's certainly an inverse relationship right now between movements in the foreign exchange value of the dollar and movements in our stock market after this unprecedented 20% increase over the last year.
There are some, though, who would say, look, the economy is only getting better. Maybe earnings estimates are just simply too low.
Right, and of course we're on the eve of another season, so we'll see. Even if earnings do a little better, and I think some of the first quarter issues were transitory, still you're in this situation where profit margins are at record highs, I think 10.1%. Again, I don't think there's a whole lot of room for multiple expansion. So you're back to this situation where I think stocks will do better than bonds or cash. But I think we're in for an era where we're looking at earnings growth plus dividends for the returns.
Okay, so in this sort of environment that you envision, what's the stock pick that you have for us and our viewers today?
We're looking at a couple of, in this type of subdued environment, we like finding companies that can grow their bottom line somewhere between 50 and 100% more than the broad market over the next 3 to 5 years. I think one good example would be Corning, the old line glass company that has done a wonderful job over the years of continuing to innovate and reinvent itself in terms of new product flow and also new applications for existing products. They've got a pretty good pipeline of new products. The latest Gorilla Glass, which has gotten very good reviews, I think exceeded expectations. You've got the K4 glass for high-definition televisions. You've got a new glass coming, Willow Glass, which is going to be as thin as paper, which looks really interesting. I like their acquisition of Samsung, their materials sector. I think that's going to be a positive. I'm very impressed with the financial strength of the company. They've got a very strong balance sheet, strong free cash flow. They've got $1.50 per share of cash on their balance sheet. They're very dividend, shareholder-friendly oriented in terms of dividend and stock buybacks. I think they bought back 12% of their outstanding shares over the last 4 years. They've raised their dividend 4 times. So this is the type of company I think that over the next 3 to 5 years can grow their bottom line substantially more than the market.